Every investment choice you make today can shape your financial future dramatically. It's a powerful statement, isn't it? But it's the undeniable truth. The path to financial prosperity isn't about quick wins or getting lucky. It's about making informed, calculated decisions. It's about understanding your options and weighing the potential benefits against the risks. Consider two potential investment choices, JEPI and VYM. On the surface, they may seem similar. They both offer ways to grow your wealth, to secure your future, and to navigate the complex world of finance. But delve a little deeper, and you'll see the differences that could sway your decision one way or the other. JEPI, with its higher dividend yield, might appeal to those seeking current income. On the other hand, VYM, with its lower expense ratio, might attract those who are cost-conscious. The impact of these choices becomes clear when we examine the performance data of two popular investment options, JEPI and VYM. Diving into JEPI, a popular choice among investors. Here, we'll unpack the performance data of JEPI in a manner that makes it crystal clear. Let's start with the basics. If you'd invested $10,000 in JEPI, by the end of your investment period, you'd find yourself with a balance of $13,659. That's a sizable increase, isn't it? But let's not stop there. The annualized return, or compound annual growth rate, CGRR, for JEPI stands at an impressive 9.32%. That's the average rate of return if you had held onto your investment over the years. Remember to subscribe and comment on what time you would like me to review next while we talk about the standard deviation, a measure of risk, is 11.09%. JEPI's best year boasted a 21.5% return, while its worst year experienced a slight dip of -3.52%. The maximum drawdown, or the largest single drop from peak to bottom, was -12.99%. Now let's talk about the Sharpe ratio, which measures risk-adjusted performance. JEPI's Sharpe ratio is 0.62 and its Sortino ratio, which also considers the downside risk, is 1.02. These figures give us insights into JEPI's performance in relation to the risk involved. The expense ratio for JEPI is a modest 0.35%. And let's not forget the dividend yield, a whopping 7.24%, which means you get a decent return just for holding the investment. With a 9.32% annualized return and a 7.24% dividend yield, JEPI can be a strong candidate for your investment portfolio. Shifting our focus to VYM, another compelling investment option. VYM is a compelling contender in the investment arena, with its own unique set of numbers that tell a fascinating story. Just like JEPI, we started with a $10,000 investment in VYM. Over time, this grew to an impressive $14,427. That's a considerable increase that demonstrates the potential of VYM. Now let's delve into the annualized return. VYM boasts an impressive compound annual growth rate of 11.04%. With a higher standard deviation of 15.09%, it does suggest a bit more volatility, but also greater potential for return. Looking at the best and worst years, VYM has seen a peak growth of 26.21% in its best year, and a minor dip of just -0.46% in its worst. The maximum drawdown stands at -14.13%, a bit higher than JEPI, but still within a reasonable range. In terms of risk-adjusted performance, VYM holds its ground with a Sharpe ratio of 0.59 and a Sortino ratio of 0.99. These numbers indicate that VYM has a decent risk-reward balance, but here's where things get really interesting. The expense ratio of VYM is a mere 0.06%, significantly lower than that of JEPI. However, it does offer a lower dividend yield at 2.89%, with a higher annualized return of 11.04% and a lower expense ratio of 0.06%, VYM offers a different set of advantages. Now that we have dissected JEPI and VYM individually, it's time to compare them head-to-head. Let's start with the performance summary. Over a certain period, if you had invested $10,000 in JEPI, your investment would have grown to $13,659. On the other hand, the same investment in VYM would have grown to $14,427. That's a clear win for VYM in terms of end balance. However, the story doesn't end there. JEPI had an annualized return, also known as the compound annual growth rate, of about 9.32%. while VYM had a slightly higher return at 11.04%. But remember, higher returns often come with greater risks. This is evident in the standard deviation, where VYM's is higher than JEPI's, indicating more volatility. The best year for JEPI saw a return of 21.5%, while VYM had an even better year with a return of 26.21%. However, in their worst years, JEPI had a more significant drop, down 3.52% compared to VYM, which only saw a slight drop of 0.46%. Now let's talk about risk-adjusted performance. The Sharpe ratio, which measures the average return earned in excess of the risk-free rate per unit of volatility, is slightly higher for JEPI than VYM. This means JEPI provides better returns for the same risk. Similar story with the Sortino ratio, which focuses on the negative deviation. JEPI again has a slight edge over VYM. But here's the kicker. The expense ratio for VYM is significantly lower than JEPI's, meaning VYM is a cheaper option for investors. And while JEPI offers a whopping 7.24% dividend yield, VYM's yield is a more modest 2.89%. While JEPI offers a higher dividend yield, VYM provides a higher annualized return and a lower expense ratio. The choice between them ultimately depends on your individual investment goals and risk tolerance.